It's Friday, 30th of May, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, what our global trade stress monitor says about tariff impacts, as well as other capital economics data developments. But first, Neil's out this week. However, Stephen Brown from our US team and Jonas Goltermann from Markets are with me to talk about what else, Trump and tariffs. So this week's rulings, if the trade war was a Netflix or an HBO series, I think they would have lost a lot of viewers this week, because how many twists and turns do we need in one show? Stephen, with the caveat that it is 9 a.m. London time, anything can happen in the next few hours. Are Trump tariffs now in the hands of the courts?
Yes, they definitely are. So we know that the first court, the Court of International Trade, has ruled that Trump has overstepped his mark with most of the tariffs. So this is all the tariffs apart from the ones on steel, aluminium, and motor vehicles. So it's the reciprocal tariffs, the 10% baseline tariffs, the additional tariffs on China. Those are deemed illegal and void, as it were, but the Court of Appeals has put a pause on that decision. So his tariffs remain in effect. We don't know the exact timings, but we know it's not going to be for at least a couple of weeks until the Court of Appeals receives the first arguments from both sides. So we won't get a ruling until at least then. And even if they rule against the administration, it would then go to the Supreme Court. So there's plenty of drama yet to come in this special. But yeah, the upshot is that tariffs remain in place for now. There's still many scenarios for how this could play out.
There are, and I know we were briefing clients yesterday following the initial trade court ruling. And quite reasonably, the number one question we were getting was, how long is this all going to take? How long is this process going to run for? But I guess the point is that even if this channel, if this gets shut down by the courts, the fact is that the Trump administration has plenty of other measures that they can draw on to impose tariffs.
Exactly. Yeah. I think our key message here would be, don't get too hung up on all the twists and turns here in the court battles, because even if these tariffs were eventually deemed to be illegal, as it were, the Trump administration has, or at least Peter Navarro has said just yesterday that they've already thought of a plan B, which is to impose tariffs in another manner, which would give them time to then impose more Section 232 and 301 tariffs. So the specifics of the tariffs could be different. Some countries could end up getting hit a bit harder, a bit less in either of these scenarios. But certainly from a US point of view, probably the average tariff rate is going to end up the same eventually, no matter how they go about doing it. It's just that we may have plenty of other twists and turns on the way there.
And also, I guess, with the uniform tariffs, with the reciprocal tariffs, Trump announced them beginning of April. Markets threw its toys out the pram. Everyone freaked out. Trump announced a pause, 90-day pause. But the president was trying to execute his authority as the president. But the issue with these other measures, you mentioned, these all take much more time, don't they, to get underway. You have to go through the investigation. There has to be findings, and then, and only then, can tariffs be imposed. So are we talking about sort of weeks or months of uncertainty now?
Well, you're right with regard to those, but there's another section that they haven't used yet, 122, which essentially gives the president the power to put tariffs of up to 15% for up to 150 days. But that period can actually be extended by Congress on any country that has a large and serious trade surplus with the US. So even if these initial tariffs do finally get cancelled, the administration could turn around straight away and apply these other tariffs. And during that 150 days, it would give it some time to start carrying out these other investigations and then impose tariffs that are more permanent. So it's quite unlikely, if that is the plan, that we'd actually have a long period without tariffs again. Obviously, never say never, but there's a framework where that just doesn't happen.
Okay, so putting it all together, what does this mean in terms of where we wind up with tariffs, but specifically with tariff revenues? Because another frequently asked question, if you like, that we've had from clients is what happens in terms of flows of revenues? If the blanket tariff plan is in legal jeopardy, does that mean assumptions about the revenues from those tariffs to offset the tax cuts that's working its way through Congress, do those assumptions need to be revised? What's your take on all of that?
Yeah, it certainly gets a lot more uncertain. The thing I would mention, though, is that part of the reason we had this 90-day pause on those much higher reciprocal tariffs is obviously because of the market reaction. So the Trump administration is trying to thread the needle here between having some tariffs and not causing markets and potentially the economy to fall off a cliff. And basically, that appears to be an effective tariff rate for the US of between 10 and 15%, seems to be what the market can handle. So even if these initial tariffs get cancelled, it's likely that we end up at that kind of effective tariff rate in some other way. And as a result, tariff revenues would still end up being relatively similar to what we've estimated, which is close to $350 billion based on that 15% effective tariff rate that we still currently are at today. But obviously it's the uncertainty, right? Even, there is this potential framework for imposing tariffs that probably would also be subject to legal battles, and markets would have to at least put some probability on the idea that the tariff revenue just wasn't that high. For instance, if most of those tariffs did end up being cancelled and remained cancelled, rather than getting 300 to 350 billion in revenue, we'd just get 100 billion. And in that case, this package moving through the Congress at the moment would end up widening the budget deficit to about 7% of GDP, instead of the budget deficit remaining near 6% of GDP as we forecast. And that could obviously cause some greater concern in the bond market.
Jonas, any sense that, based on what we've seen in the past few days, that bond investors are worrying more about the deficit picture in light of all of this? And what's the view from the bond market?
Well, bond yields fell pretty sharply yesterday, so I don't think that they are really taking their cue from trade policy as such. I think what really matters there is the US fiscal package and more broadly how the economy evolves. Those are the two things that really matters for bond markets right now. And if you take a step back over the past 2-3 weeks, we've seen quite a bit of pressure on the long end of the bond market, both in the US and elsewhere, as this fiscal bill went through the House. You also have the Moody's ratings downgrade. That's not news per se. Everyone saw that coming, I think. It's just a matter of time, but it adds to the negative mood. Then you saw the ultra long end of the curve in particular has struggled, and there's been a significant steepening of yield curves across the sort of the big bond markets. The US 30-year yield briefly traded about 5%. And then this move has come as its long end yields going up, even as short-term rate expectations not really moving that much on net. So it looks like that was a move in large part driven by a term premium expansion, which I think is pretty reasonably you would interpret as a reaction to greater fiscal risks. And it's not just in the US, yields are going up in all the major markets, really. So the US fiscal package is probably the most important single factor, but it's not the only one. Fiscal policy, high net issuance is a challenge for bond markets in Europe and Japan as well. Central banks there are still shrinking their balance sheets, and basically it looks like the private sector is struggling to absorb the net supply of long-end bonds, and maybe there's an adjustment needed there. And we've seen that already. One of the responses to this has been that debt management offices, both in Japan and the UK, earlier this week suggested they would reduce issuance at the long end and basically issue more short-term bonds where the market isn't struggling to absorb that in the same way. The US has already, in effect, been doing this for a while. They've kept the issuance of T-bills higher than normal for the past 2-3 years, and then the Trump administration has continued that, and that all helps at the margin to reduce the pressure at the long end.
In a nutshell, not so worried at the moment.
Yeah, I think in a nutshell, the bond market is balancing between two big fears, if you will. On the one hand, you have this problem of excessive fiscal policy and excessive issuance and upward pressure on yields through that channel. And on the other side, you have, I think, still a lingering fear of recession or a slowdown, which would point to much lower yields potentially. And so those things are balancing out, and that's why we see this kind of back and forth. If you look at the US 10-year, for example, the benchmark, the range this year has been from about 4.8, 4.9 to down to below 4%, so almost 100 basis point range. Those are the two extremes, and the term premier problem or at the lower end of that recession. And I think we're probably going to see a fair bit more volatility over the course of the year.
Let's talk about that recession question. Stephen, how is the US economy bearing up in all of this? Another way of framing that question is one that was posed in the title of one of your team's reports last week. Was Trump right about tariffs?
Yeah. I think we should say we need to make a bit of a distinction at the moment between GDP as it's measured in the data and the economy more broadly. So we know GDP contracted in the first quarter. We had data this week confirming that again, but that was largely due to the surge in net imports. And in the second quarter, we could see that effect reversed. So we get a much stronger GDP reading. But that won't necessarily reflect the kind of underlying strength of the economy. So we need to pay more attention to the labour market data in particular. So we get non-farm payrolls for May coming out next Friday. We're forecasting 150,000 gain, which would certainly be solid considering the circumstances and certainly given where fears were about a month ago. But clearly there are some downside risks to that forecast. So we know, for example, that some of the employment indices of, for instance, the S&P Global Composite PMI, that's fallen below 50. It's got a pretty terrible track record against actual employment changes, but clearly there's some weakening of sentiment here with regard to firms' hiring plans. But elsewhere, the data haven't been exceptionally strong, but for the most part so far, retail sales, production are holding up. They're certainly not falling through the floor. So I think at the very least, there's some support there for our forecast that economic growth probably will slow over the course of this year, but certainly the economy doesn't yet face recession as the highest risk.
What about on the inflation front? We're talking post-Fed minutes from the May meeting. We're just hours away from April PCE inflation readings. What's the view from the Fed? Trump and Powell had this meeting this week. There's more pressure on Powell to cut rates. And then the Fed puts out a statement. You could read it between the lines as something like, despite your pressure, legally, you can't touch us. Leave us alone. Let's get on with what we do. Give us the view from the Fed.
Yeah, the Fed is, I think it's in a comfortable position, to paraphrase its own words, really. It's happy with the fact that the labour market and the economy do seem to remain solid. Certainly in its last policy statement, it reiterated that point. And because of that, it's got time to wait to see how tariffs affect both the economy and prices. We really haven't seen any real tariff impact so far, but we are seeing signs that price rises are likely to start coming through from June. So, for example, several companies have suggested they'll start hiking prices in response to tariffs. Several automakers in particular have suggested that's when prices are going to start rising. Several Fed officials have also told us that they probably wouldn't be ready to cut again, even though that is still their kind of baseline projection, until September at the earliest. Our own view is that they won't cut because the economy will hold up and inflation will rise. But it certainly doesn't look like we're going to get any real change in either tone or policy anytime soon, but the next meeting's in June or July.
Has the market come round now to our view that we're not getting rate cuts this year?
Markets, the average market pricing, for want of a better term, maybe Jonas can correct me, is pricing in 225 basis point rate cuts. But I think if you look at the kind of modal probability implied by options markets, it's suggesting one rate cut as the most likely single outcome. So not quite come round to our view, but certainly has come closer to our view since recession fears were at their highest.
Jonas, talk to us about the equities markets. We saw that big move up post-Liberation Day. Does this rally still have legs with all that's going on, with all the uncertainty that Stephen's been outlining?
We've gone sideways for the past couple of weeks, really, as the news flow has turned a bit more negative, or a bit more mixed, I should say, between the trade policy stuff, which has been, the tone's been a bit more negative. Obviously, the fiscal bill, the uncertainty around that, and maybe some of the economic data has been on the soft side. The only real bright spot has been Nvidia's earnings yesterday. Obviously, that's an important litmus test for the tech sector, key to the US market. And that report was pretty solid. So that's the one bright spot. But yeah, take a step back. It does feel like the immediate rebound from the April fall has probably run its course now. Most equity markets are actually back ahead of where they were on 2nd of April. The US is not quite back to its February P, but about 5% below that. That's a 20% plus rebound from the trough in early April in less than 2 months. That pace clearly is not going to be sustained. That's something that happens in a rebound phase and then fades. So we are on to the next phase now. And some people will say sell in May and go away, because maybe it's hard to see where the next positive impulse is going to come from, at least in the near term. We have, I think, still the fiscal policy is probably the next big hurdle to overcome in the next month or two, where I think markets are looking for an outcome that gets a fiscal bill passed to avoid this fiscal cliff, avoid the debt ceiling on the one side, and at the same time a bill that doesn't expand the deficit significantly and create problems for the bond market and via that for the equity market. So I think that the pace is going to slow down compared to the past couple of months, and hopefully the volatility in the equity market can continue to normalize. Then we'll see a sort of a return to normal, if you will, in the equity market, which is, I think, still reasonably constructive backdrop. The economy holding up and policy uncertainty is still high, but maybe on a gradual decline. So I think it's reasonably constructive is my view for the next few months.
Jonas Goltermann and Stephen Brown on the latest twists and turns in Trump's tariff plans and the market response to those. On equities, I should note the team's just revised up its end 2025 forecast for the S&P 500. I will add the note explaining that revision to the podcast notes, along with new forecasts for non-US equities. I just wanted to mention the coming week's drop-ins. These are our short-form online briefings. There's one on commodities, so that's catching up on key stories in markets there, including gold, OPEC Plus, and what to expect from industrial metals under a higher tariffs regime. That's on Wednesday. And earlier that day, we're doing a session on what happened in Tuesday's presidential election in South Korea. Details about those on our events page. Now, I've taken to asking Neil Shearing, our group chief economist, on the podcast every week about any evidence that tariffs are affecting the global economy. His answer invariably draws on our global trade stress monitor, which tracks high-frequency measures of activity all along the trade cycle, from factory orders right through to the end user. Because Neil's out this week, I thought I'd ask Justin Chaloner instead. Justin is the head of economic data here at Capital Economics, and he's responsible for managing a team of data economists who are busily churning out prop indicators, interactive dashboards, and much more for clients. So here's my chat with Justin now, and it starts with that obligatory question: is our data showing any evidence that Trump tariffs are having an impact on the global economy?
Thanks, David. So with our stress monitor, we're looking at different stages of the world trade cycle so we can identify where tariffs might be having effects. And then what we've seen so far is that to the extent that there have been effects, these effects so far have been concentrated upstream at the factory order and production stages, so outside of the US. So we've refreshed the latest data this week, and we'll be doing it at the start of next week as well when we get the latest PMI data. And what the data shows so far is that business surveys have softened, they've weakened a lot. The PMI manufacturing new export orders, they've fallen sharply in Canada, Mexico, economies, and Asia. So that all points to weakness further ahead. And when those PMI data come out next week, we'll be looking to see if there's further evidence of that continuing.
And that's going to be published on Monday?
Yes, that's right. So on the 2nd of June.
And what else have clients been watching this past week? What are the hot dashboards of the moment?
So one of the most popular ones this week has been the update of our China Activity Proxy, or CAP. So this is our long-running attempt to track the pace of growth in China without relying on official GDP figures. It's based on a series of low-profile indicators that have been chosen to reflect activity across a wide section of the economy. And what this latest update shows from this week, it continues to show divergence between the official and analyst take and our more downbeat view on the Chinese economy. So the latest release of our China Activity Proxy, that does suggest that the economy's growth did slow in April. But what's really interesting is looking at the sectoral breakdown. And so far, US tariffs seem to have had a bigger impact on consumer sentiment rather than industrial activity. And that's where trade rerouting and the depreciation of the renminbi on a trade-weighted basis have helped to offset the fall in exports to the US.
So it's the construction and the services sub-indices, that's where the weakness is coming through in the cap, in the headline.
Yes, that's right. So far, the US tariffs seem to be having the biggest impact on consumer sentiment, and construction activity has also slowed.
Okay, I know that you and the team are beavering away working with the macro and markets teams on new data tools, new developments. Can you give us a preview of what's in the pipeline? Tell us what's coming up that you want to flag.
So this week, we've launched a new dashboard that looks at rerouting of trade between China and the US. And so to build this, our China team has looked at trade in thousands of individual products to work out what's really going on with trade rerouting and trade diversion. And this is a very important topic because the economic impact that high tariffs will have on China is going to depend on the extent to which Chinese firms can still benefit from US demand, by reorientating trade flows through other countries. So these estimates are going to be updated monthly, and we'll be able to monitor how trade flows are shifting in response to tariffs.
Can you see any sign of reroute? I'm trying to get Leah Fay, who's one of the lead economists on this, on the podcast next week, to talk more about rerouting. But what are we seeing so far?
So it's still early days, but looking at the data from during the first Trump administration, trade rerouting should offset a significant chunk of the fall in China's exports to the US. So that's trade going via Mexico or other key Asian economies.
Okay, and what else is on the docket?
In the coming week, we're making our tariff impact model even more useful. So we're going to make it possible for clients to input even more granular scenarios so you can test out what impact different tariffs on different products, different countries, what impact that would have on different economies. And further ahead, we've got new commercial real estate dashboards coming, and we'll also have new financial markets dashboards with term premier estimates for G10 bond markets. And we're also working on new proprietary indicators for tracking inflation. And even further ahead, we're putting together a new tool for tracking where advanced economies and emerging markets are across the economic cycle. So lots to come.
That was Justin Chaloner, the head of data at Capital Economics. He mentioned our global trade stress monitor, our China activity proxy, our tariff impact model, our new rerouting dashboard. All of these could be found on the data page of our platform, which I will link to in the podcast notes so you can explore them. And we will be sure to have Justin back on the show in the coming weeks to talk more about data developments at Capital Economics. Speaking to Justin reminded me that Ruth Gregory's analysis about problems with UK data was published earlier this week. Ruth, she's our Deputy Chief UK Economist, was on the podcast last episode talking about the risks of a policy mistake because of problems with things like the UK Labour Force Survey. It's also worth mentioning now that our UK employment indicator has been launched to give you a more accurate picture of what's happening with UK jobs growth. I will add Ruth's report to the podcast notes, well worth checking out. For access to our macro and market data, including our prop indicators, as well as all of our analysis, all our drop-ins, much more besides, do check out CE Essential and CE Advanced. These are our all-access package. They've been designed to give you the full picture, but also make sure you're not swamped with content. So you can basically personalize them so you just get the insight that you need. Do drop us a line at sales@capitaleconomics.com and we can quickly set you up with a trial account. But that's it for this week. Neil will be back next week, and I'm going to take a wild stab in the dark and say that Trump and tariffs will be on the agenda. But we'll also have more on that China rerouting story, a review of Thursday's ECB meeting, and much more besides. Until then, goodbye.